Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right. No extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Jonathan Blau. He is the founder and chief executive officer for Fusion Family Wealth, a Long Island-based fee-only, not Long Beach, but Long Island, fee-only registered investment advisory firm. His investment philosophy is centered around helping shape positive money behaviors and teaching wealthy people to consistently make rational financial decisions under uncertainty. His firm has $1.1 billion in assets
Actually,
under
I'm sorry,
management.
that's an old one. We're at $1.6 billion.
Oh, there you go. No, it's huge advancement there. So $1.6 billion in assets under management. And then he believes that investors' temperament, what one does, as opposed to intellect, what one knows, is the dominant variable determining investors' success or failure. Jonathan, looking forward to our conversation today.
Likewise, Keith. Thanks for inviting me on as a guest for your audience. I appreciate it.
Absolutely. And I always love to start with really your background, where you grew up and what eventually led you to this profession of advising people on their wealth and on their finances.
Sure. So it's interesting. So I grew up in a little enclave in New York called Bayside, Queens. So in Queens, New York, and I grew up in probably a middle class to lower middle class socioeconomic background. I had grandparents who were more comfortable, and certain relatives who were very successful, like my mom's brother is my uncle. And what I learned growing up about money is that one thing, it didn't make people happy. I never saw my uncle smile a day in his life, and it was probably, I don't know how much it was worth, but I've heard estimates of $500 million. But I don't think I ever saw him smile once in his life. And some of the things I observed, my cousins and so forth, never achieved, from my perspective, in my opinion, any of their own successes. It's kind of born on third and think they hit a triple. And so when I witnessed all of that, I recognized that there was a problem with our societal association with wealth and wisdom. The cousins had money, but I never saw them as wise. But people who saw the amount of money they have always assumed they knew what they were doing and they were smart, whether they earned them or not. So that was the first kind of thing that sat in my brain, is that, this money thing, there's some issues with the reality of having a lot of money and the narratives and perceptions society creates around people who have a lot of money. And so that was a long time ago. And then I worked as an intern at Lehman Brothers, which is now out of business. It went under after over 200 years in business during the financial crisis. And I worked in the summers of 87 and 88 as an intern there. And what I saw is the people they used to hire at Lehman Brothers for what they called their investment banking group, which was really stock sales, were people from
Yeah.
Wharton and Harvard and so forth. But they realized those people couldn't sell, so what they changed their recruiting system to do is recruiting in those days from or the then top sales training programs, and those were companies specifically IBM, Xerox, a
Yeah.
company, a company that most people never heard of, Linear Products, and the same kind of business as copiers and so forth. And they took these people who didn't know anything about stocks and bonds out of the sales training program, and they gave a 4-month training program at Lehman Brothers to them. And that 4-month training program was basically locking them up in a room for 4 months to study for a test, the Series 7, that should take 4 hours to study for. And they passed the test, and then they became one of the most successful in the 80s sales teams at Lehman Brothers when they went away from the people who had intellectual backgrounds at big schools to the people who knew how to
Right.
sell on big sales training programs. What I learned there is there was a void in the industry for true advice. These people weren't offering advice to wealthy clients. They were offering pre-formatted sales pitches, to get
Right.
to attract them to open accounts, to trade stocks, and do second and third and fourth trades with them and so forth. So that's what gave me the idea that there's got to be a better way to learn to help people than what they were doing back then. And of course, the industry evolved over the years from being what they called a customer's man or a customer's person, where someone would call up and say, "Hey, I have IBM for you. You buy it at 20 and we'll sell it at 30." But then they really sold it at 10 and told them to buy Sears, and they just kept going and going and going. So there had to be a better way, and the industry did evolve from that into more of an advice-based industry. And then what I learned is the advice in our industry was based on from my perception, a lot of misdefined characteristics, meaning the industry tells investors, and we've all been acculturated to believe from the time we came out of the womb, basically, that the biggest risk we face as an investor in the capital markets is volatility, which I define as
Right.
the temporary up and down movements around the long-term uptrends. So the temporary changes monthly in the number of dollars on our statement. We're told to assume that's our biggest risk. And when we define risk that way, the industry solution was always have more things like bonds, because bonds don't fluctuate and they protect you against what I call that illusory risk called volatility. So we've built our business over the years redefining risk and safety, so that's not in terms of temporary fluctuations or volatility, but defining it in terms of the actual real risk, what I call the real external risk, which is inflation. The
Yeah.
compound erosion every year, not temporarily like fluctuating values every month, but permanently of the value of every one of those dollars. And by
Yeah.
misdefining risk and safety as volatility, what the industry has done is put into the portfolios the very carrier of the disease of money I call inflation, which is bonds, things that freeze the money for the lifetime and the principal of it, and the interest
Yeah.
for the duration of the bond at the level of it, so it never accretes or grows to defeat the threat of inflation. And so there's a reason the industry defines risk that way, which we can talk about as we go on. So we've taught our investors to redefine risk and safety. And so most of our investors are taught that you don't need 40% in bonds. You don't need to have all this money in bonds to effectively try to fight volatility. Volatility is not our enemy. And so what we do is we tell them we need bonds for one reason. When you're 2 to 3 years from retirement as an investor, you should have bonds about 2 to 3 years worth of spending. So if someone has $10 million and they spend $400,000 a year, maybe they should have $1 million to $1.5 million outside of equities, which would be 90% of their portfolio in equities, plus or minus. It's very different than what the industry will tell an average 62-year-old retiree to do.
Yeah.
And so we start teaching that, and they eventually have the same response. Well, that actually makes sense, but why does anyone else tell you? You can't be smarter than everybody else? It said, it's not that I'm smarter. I used to practice the same way before we founded Fusion, in 2013. I was taught the same way, but I was mistaught like everyone else. It wasn't like we're trying to do something bad. There's a guy who
Yeah.
in the 50s named Harry Markowitz who won the Nobel Prize for economics for his work in really what's called modern portfolio theory, which in English is just there was a way before his work to compare one portfolio based on historic returns to another and figure out the one that's likely to be the best one going forward. They might call it the most efficient one. And he said, but wait a minute, that's not good. Comparing returns, you've got to also have a comparison of the risk of each one of these things. And he chose to define risk and uses the variable for risk in his model, volatility, variance. So now the whole industry accepts that as risk, and he's responsible, in my view, is smart. He was smarter than I'll be. It was Harry Marcus, but he's responsible for creating, destroying, helping the industry destroy more wealth single-handedly than any other person in our industry by misdefining risk and safety in terms of volatility and causing the thing that kills wealth, bonds, that supports inflation to eat away at money every year. So the problem that investors have is I can teach them all of that and it makes sense to them. But then they say, by the way, we have bonds, 2 to 3 years living expenses. And the reason we tell them to put 2 to 3 years living expenses in bonds as they get close to retirement is because the average from a peak, for example, in the S&P 500, the broad U.S. market, to a trough, which is down, average bear market's down 33%. So let's say the recent peak is 7,000 in the S&P, a trough would be 5,000, and back to new highs. Past that has taken 40 months historically for the last 100 years on average. So as long as you have 2 to 3 years living expenses, you fight the real threat in what I'm describing, which is called sequence of return risk. So in other words, we can be pretty confident that over long periods of time, stocks have made 10% a year. Done it for the last 100 years. Can't have any confidence in the sequence of those returns, what they'll do next year and the year after. So to protect against that, we keep a few years of spending in bonds. That's it. And so the key, though, is most investors can stay with that plan, 85, 90% equities during retirement through pandemics and recessions and tariffs and Trumps and Bidens and Ukraine invasions and Iran invasions and you name it. And so we had to teach them to unpack the behavior that we're programmed with for survival, not of the vagaries of the capital markets, but of the threats of bears in the woods, not bear markets. African savanna, a million or hundreds of thousands of years ago, we had without thinking, be able to protect ourselves and our families. So we have this thing in the base of our brain called the amygdala. It shoots off a fear sensor, and we run without thinking. As soon as we hear a lion roar or rustle in the bush, whatever it is. The problem is that's the worst way to be programmed to survive financial vagaries. So when the Dow is down 30% and you're in a bear market, the amygdala doesn't know the difference between a bear in the woods and a bear market, sends off the same signal, and we're doomed. So there's a lot of things that we have to teach people how to unpackage and learn to suppress those biases. So not to suppress their fears during the real events that cause fears, but to not reflect those fears by changing their long-term, well thought out portfolio strategy. So that's in a nutshell, right? That's what behavioral finance is.
No, I love it. It makes a whole lot of sense. And, for the audience, you talk about bonds and you talk about how, as most people perceive those as, kind of safe because of the lack of volatility. But, when you compare the returns on average, what do bonds return as and compare, I guess, that to the rate that we have been experiencing. And the rate, also the rate that we've been experiencing on inflation.
Yeah, so let's talk about that. So basically, I can give you from the time, I'm going to put something into my computer now because it's going to help me give you some real specific things. Why don't you tell me the month and year you were born?
Okay, December 1975.
So a little bit after me, but that'll be an interesting. Okay, so I'm going to go to December 75, and what I'm looking at now is the Standard & Poor's 500 during your lifetime.
Okay.
So during your lifetime, so long term since 1926, so basically the last 100 years, the S&P 500 has returned over 10% a year with dividends. Put that aside for a second. Inflation has been about 3% a year, by the way. So after inflation, stocks have returned 7% a year.
Yep.
which is fully 2.5 times more than the equivalent bonds return, which is the equivalent, meaning similar companies, if not identical, which is 6% before inflation for bonds, 3 after. Stocks, 7 after inflation, bonds, 3. So every
Yeah.
investor needs to know if they're going to succeed through a 30-year average retirement, they need a hell of a lot more 7s than they do 3s. That's the first thing. But in your
Yeah.
lifetime, so this is always interesting for me, when you were born, it just not a test, but just curiosity. Where do you think the S&P 500 level was at? It's at about 7,000 today.
Geez. You said it's at around 7,000 today?
Yeah.
Let's say 4,500.
How about 88? Less
88.
than 100.
Wow.
Okay. So
Yeah.
in your lifetime, the S&P's gone from 88 to 7,000, or that's to say 100,000 invested, right? But back when you were born is now worth $8 million. It's gone up 80 times. Think about
Yeah.
it. Now,
Wow.
so far, that doesn't tell anyone anything because, to your point, I have to know if I have 8 million by having put 100,000 to work when you were born, what does it take today to buy 100,000 worth of stuff, right? Inflation. That's it. If
Right.
it costs more than 8 million and stocks didn't do me any good, right? So
Right.
inflation, the consumer price index in your lifetime went from about 50 to about 300, so up a little over 6 times. So I need 600,000 to buy what 100,000 bought today. Stocks didn't do that for me. Stocks leave me with with 8 million. So I didn't keep up with inflation. I beat inflation by about 13-fold. So my standard of
Wow.
living
Yeah.
by just the stock companies that I invested in, prices going up, has gone up 30 times. But here's what most people miss. When you were born, we know what the stock market was now. It was 890 or so, 88. But dividends, right? Dividends, dollar dividends. So if you add all the dividends of the 500 companies up and you divide that number by 500, you get the average dividend, right? So they all pay
Yeah.
dividends.
Okay.
So the average dividend, the payout that was due to you as a shareholder who invested 100,000 was $3.68. Now $3.68 divided by the price then of the S&P is about 90, gives you a dividend yield, right? Like an
Mm-hmm.
equivalent of a
Yeah.
bond interest rate of 4%. So it means on the 100,000, you were getting 4,000 a year in just income, right? In income
Yeah.
when you were born. But stock dividends, unlike bond interest, is not frozen. Stock dividends for the last 80 years have grown not to keep up with inflation by 3% a year, but double. Stock dividends for companies increase their dividends over time, an average of 6% a year. They've grown double inflation.
Wow. Yeah.
So what that means is the dividend dollar amount being paid out when you were born, which I told you was about $3.68, called $3.70. Today, if you just held those stocks, the same companies are paying out about $80. So if you take 80
Wow.
and divide it by $3.70. Sorry, let me do it the right way for you so I give you the right number. So if we take 80 and divide it by $3.70, that means the income that you were getting, which was $4,000 a year when you started,
Yeah.
4%, is now up 22 times because the dividend has gone up 22 times from 368 to 80. So what that means in English is 22 times 4,000. So you're getting about $87,000 in income. Now, again, let's look at
Nice.
inflation. Inflation's up about 6 times. So 6 times for the 4,000 in dividends that was generated the year you were born, I would need
Yeah.
23,000 today. My cash flow, spendable cash flow, forget the fact that my value of what I own went up 80 times. My cash flow went up instead of 6 times, it went up from $4 to 80, so it went up about 22 times. So I
Yeah.
have 80 something thousand, which instead of needing 24,000, I've increased my cash flow standard of living fourfold almost. Fourfold. So I didn't
Wow.
just keep up with inflation. I can buy 4 times in today's dollars the equivalent of what I might used to buy for that same 4,000. So it's like a miracle. Okay.
Yeah.
And the
Yeah.
problem is most people don't have the temperament to understand the miracle doesn't come for free. There's not a toll in the sense of a dollar-based toll to pay to get access to it. There's an emotional toll. We've got to understand that stocks lose on average since 1980 about 15% each and every year. When I say lose, I don't mean that they stay down there. It's called a drawdown. They might have been at just recently we were down over 10% on the Dow for the year. It had a
Right.
high of over 50,000 and it went to 45,000. It was down over 10%, and now it's almost rebounded all the way back. That every year that number is about 15%. So if you're going to succeed as
Okay.
an equity investor, you have to be prepared, I tell people, to watch 15% of your equity money appear to disappear each and every year and not reflect your thoughts about what that means by changing your portfolio to try to run for perceived safety. Smooth doesn't equal good in investing. Okay, smooth actually is bad, right?
Yeah.
That's the perception we have. Let me go to bonds because that won't fluctuate. Yes, and it'll also freeze all of your money into the biggest threat for the next 20 years, and you'll probably cut your lifestyle in half at very best, and potentially eventually run out of money if you live long enough. So we need to understand we should never be responding to the thoughts. Now, 1 year and 5 or 6, it's not just a 15% average decline, it's a third. So every 5 or 6 years, we have a bear market on average.
Yeah. Yeah.
And the average one is not down 20%, which is how we define a bear market, 20% down from a recent high, not for the year, but from a recent high. It's defined by the industry as down 33% on average. That's the one, that's the average bear market. So I need to be
Okay.
able, as a successful equity investor, every 5 years or so, to be able to watch 33% of my equity money, again, appear to disappear and not do
Right.
anything about it with respect to my portfolio. And it's hard to do because oftentimes when you have those types of declines, there are real things going on in the world that are causing them, that cause you to have angst. But we need to
Right.
be prepared and understand that the 33% decline on average and the 15 every year, that's part of the package. If you want to get an average of 10% a year for the bulk of your investments, have a good probability of that, you have to
Uh-huh.
not think you can get out of those investments before the declines and then know magically how to get back in before the can't be done. That's called market timing. No one can consistently do it. And in fact, people who try often get much less than half to 10% returns that other people who stay with it get. So you have to understand if you're gonna have a chance of getting those 10% returns, you have to be willing to accept every ounce of what they call volatility that's involved along the way for the rest of your life.
Yeah.
15% a year on average, and the 33 is every 1 year and 5 or
5
6. By
years.
the way, right before you were born, I was born in 1967. From the
Okay.
time you were born, there were 50% or more declines in your lifetime, and you're a young guy. That
Yeah.
normally happens on average, statistically, once in 100 years. In my lifetime, which is not that much longer than yours, happens to just be the way it happened. Since 1967, there were 3 times where the market halved or more. That was
Uh,
1973 and 4. They called it the Nifty 50 bubble. 2000 to '02, the tech bubble bursting along with the terrorist attacks, and then just 5 years later, the great financial crisis, down 60%. But with that, the S&P in your lifetime has gone up at 11.8% a year with dividends. So what one had to do to experience those kinds of results is to buy the Standard & Poor's 500, put it in a drawer for your lifetime, elect to reinvest the dividends and not look at it. And the problem,
yeah.
human beings can't do that on their own. That's the problem.
Yeah. I mean, it's difficult, right? And as you
It's
said,
almost
there's
impossible.
yeah, and there's things out there that you start to, well, we got this war in Iran. What if this leads to World War III? Like you just keep feeding,
Yeah, you feed the
more and more.
apocalyptic speculation. That's what you do. And
Exactly.
and the trouble
Exactly.
is, the reality is I never tell people that all of those speculative thoughts are impossible to come to fruition. They're very possible. They're not likely, but they're possible. But the
Right.
trouble is you have to now, we teach people rationality, as you mentioned in the beginning, under conditions of uncertainty. So what that means is, let's say there is a World War III with nuclear Armageddon, right? Does one
Right.
think as an investor that they'd have a better outcome if they had bonds at that point than stocks? In investing or life? No, of course not. So when people
Right.
invest for the apocalypse, what always has happened in my entire career, and I suspect always will happen, is Art Cashin was a famous guy who worked for UBS on the Florida Stock Exchange, a very vibrant character, and he said something like, paraphrasing, "Never bet on the end of the world because it happens once in a lifetime, and betting on something that only happens once in infinity is very long odds." So that's the first thing. The second thing is what I said initially is you can't run from that. So people who invested for the apocalypse, they buy gold and seeds and fencing and bonds and cash, all the things that haven't grown with inflation at all. Forget beating it
Right.
like stocks. So they ended up, because the world hasn't ended ever, they ended up with a world that didn't end, but having invested only for one that would have ended. And so they created their own financial apocalypse because they basically ran out of money or couldn't at
Yeah.
all sustain their lifestyle after 10 years into retirement. And so that's the worst thing people could do. So those things are possible, but because you don't know if and when they'll happen, you cannot marry a successful investment plan to any apocalyptic speculation. And and
Right.
and,
Right.
and so it's okay to feel the fears, but it's never okay to lose sight of what your investment objective is, which is I'm investing assuming the world isn't going to end, and what investments will likely give me the highest probability of financial survival in a world that doesn't end. If the world ends, I don't need to worry about financial survival.
Exactly. Exactly. Wealthflow audience, pardon me for a quick interruption to today's show, but I have some exciting news that I want to be sure that all of our listeners are aware of. We just launched 3 totally unique to the market funds that are at the cutting edge of technology and AI. We have combined my 25 years of real estate experience and my recent work as VP of development for a tech company to bring 3 awesome investment options to our audience. For full details, go to our website at bobocapitalventures.com. Again, that is BOBO capitalventures.com. All right, back to the show. I love how you're breaking this down. I mean, just understanding that you're going to see that sometime within the year, you're going to go down 15%. Your equities are going to appear, as you say, to disappear. About once every 5 years or so, it has an opportunity to potentially go down 33%. And then,
And by the way, that's the
and our,
average. It can go
yeah,
down more than that, as it did in 2008 and 9.
that's right. But it bounces back, and it bounces back fairly soon after that. I mean,
Let
when
me
you
let
look
me
at
let me add something to what you just said.
yeah,
It doesn't bounce back. It comes back, but then goes on to wild new all-time highs. So, for
right,
example, before the decline in 2007-8, the peak in '07 October was something like 1,500 and change on the S&P, right?
hmm,
So what happened is it didn't go to 650 by March of '09 and then just come back to 1,500. We're at 7,000. For the list
right.
since '09, we've not come back. We've compounded at 17% a year. It's the second best bull market in history. The first best was 1982 to 2000. So it's very important. It doesn't just come back. It goes on
Yeah,
to
yeah.
wild new
That's a
all-time
good
high.
distinction.
It's always happened that way. Doesn't mean it always will, but betting against that and betting against human ingenuity and innovation and population growth, that's what you're doing when you bet against equities. You don't own
No,
the
I
stock
think that
market as an investor. You own great companies. The evidence of your ownership is through stocks, just like the evidence of your house is evidence through a deed. It's not that you have something on paper. You own your house, you own a piece of Apple. When you own stocks, you own a piece of Nike and so forth. So people need to also embrace that thought. We don't own the stock market. The stock market, I say, is one of the craziest places where some of the craziest people gather every day to respond to some of the craziest things. That is not what we own. We own the companies that trade on the stock market.
right, right. No, that's a good point. Good point for sure. How about when we talk about you mentioned dividends, and you had a great example with respect to that. And so when you're looking at and advising, when you look at different stocks, are you saying, hey, a group of those should be dividend paying stocks for sure? I mean, that should be a piece of everybody's portfolio, or, what's your recommendation with
Yeah.
respect to kind
So
of looking
it's
at
a very
dividends?
important question. In fact, I don't encourage chasing dividends.
Okay.
So by definition, when you invest in a broad index like the Standard & Poor's 500, many of the companies pay dividends. But the distinction is a lot of investors make big behavioral mistakes when they're headed to retirement for a bunch of reasons. So one thing, for example, is they misdefine income as interest and dividends only, when the majority of income for true investors has come from capital gains, which is defined in Section 61 of the Internal Revenue Code as under income. It's capital gains counts. But people, because of
Right.
the ambiguity of when it comes and when the increase and declines, if for some reason they, I don't count that. No, you do count that. When you spend into an average expected return of 10% for equities, it doesn't mean every year you're getting 10, but if you're spending 4% a year from the portfolio and you average 10, that's good. It doesn't matter that some years you'll make 20 and some years you'll lose 20. Irrelevant, because when it's really down 20% or more, we switch the spending away from equities to that 3-year pool we talked about in short-term bonds. So you're not going to
Yeah.
liquidate your stocks while they're temporarily down. That's all that's important, that you keep your spending at the same rate. But dividends, the reason I don't encourage high dividends, and this is very important, is so the first big mistake is people say, what's the best yield you can get me? And then they limit themselves to investments that won't grow for inflation because they're only looking at interest and dividends, and their returns are going to be not only very low, but frozen to inflation in those things. So that's a horrible thing. But the other big mistake they make is, when I'm retiring, I'll buy stocks, but I should buy the ones with high dividends, because again, there's
Right.
this perception that that's certainty. I mean, but the thing to remember is there's an inverse relationship always, as a principle of finance, between certainty and return. The more you have of one, the less you have of the other.
Yeah.
If I look for more certainty and have more bonds, my return's going to be lower. If I look for less certainty and I have more stocks, I'll have less certainty about when I get returns, but my returns are going to be higher. That's the way it's always been, and likely the way it always will be. Now, when you have a dividend of 4%, where the S&P's average dividend today, let's say, is 1.2, something like that. So you say, gee, that's good. I'm starting off with a big head start. I got 4 times the income coming in. I got to do better. So
Right.
it's a common misperception. So think about this. The reason it doesn't work is, again, the same reason people think that the dividend, the interest income from a bond is going to do better than stock returns, just because it's ambiguous. It's the same thing here. If a company is paying out higher dividends in the S&P, let's say an S&P-based company, paying out higher dividends than the average, say 4 or 5% instead of the 1.2 average, why are they
Mhm.
doing it? Why are they paying
To
high?
attract investors,
No,
because
no, they're
maybe
not.
they didn't meet their return. No.
Yeah, no, they're not doing it. They're doing it. Remember, these people are fiduciaries. These people, meaning the CEOs who run these companies, they have to make
Uh-huh.
decisions in the best interest of shareholders. The only reason, on average, that they're paying such a high dividend is because their business is mature and isn't growing fast enough to warrant reinvesting it in the business. So it's in the shareholders' interest to pay it out to them.
Okay.
So your
Okay.
total return in those companies can be less. The perception is somehow, if I'm starting off with 4 and stocks return 10% a year, I'll make 14. That's not how it works. If you're starting
Yeah.
off
Yeah.
with 4, you ain't going to make 10% a year total, because you're getting more certainty up front and the company isn't growing fast, which is why they're paying you so much dividend. So your total
Right.
return, which is all I should be interested in, is going to be much lower on average in the high dividend companies.
No, that makes a lot of sense. I've seen where they've announced a new, an increase in dividend after they didn't make, their expectations, and it's probably, it probably
Well,
just
sometimes they'll do
happens
that
to
to
be the
show
way it
strength.
happens.
They'll show strength,
Right.
but on average, that's what's going on, right?
No,
So
it makes sense. Makes sense what you're saying.
companies can pay special but I'm talking about broadly speaking. You do not want to, if your goal is to maximize total return, which would be every investor's goal, not to maximize the
Yeah.
income, the way they define it. Which is
Mhm.
misdefined, in terms of interest and dividends. The goal should be to get maximization of total return, and seeking high dividend stuff isn't going to get you there.
Yeah. Okay. How about, just thinking just for the audience here about, from an investment standpoint, when we do talk about investing in equities, are you looking at individual companies and betting on the individual companies, buying the individual stocks? Are you, a proponent of index funds, something that, you get a broader spectrum of multiple companies so you don't have to necessarily pick the winner in each of those, or what's a good strategy from your
Yeah,
perspective
I'll
there?
talk to you about that. And again, another important misperception in our industry when I give you the answer. But let me ask you a question. I want to take a Socratic approach to this initially. Answer your question with a question. Um, w- what do you perceive from a successful return expectation standpoint is the attraction of picking stocks or hiring someone to pick stocks versus just buying an index?
The perception is that it's going to go up in value more, and they're going to be more accurate at being able to pick that than, you know, if I'm paying somebody to do it, that they this is what they do for a living. This is,
Yeah.
they can pick those winners.
So I don't want to burst your bubble, but that's what everybody thinks. So
Right.
let me give you something eye opening. And the statistic I'm about to give you, I'm going to give you for 15 years. When you go at 20 years and beyond, it gets much worse. But the 15-year statistic, to your point, not for the emotional people like me and you who aren't professionals at picking stocks, talking about for the people
Right.
who spend millions of dollars on technology and research to be in the stock picking business, right? To
Yeah.
professional managers, money managers, mutual funds. Over 15-year periods, what percentage of those people who get paid the big bucks to do this consistently, um, do you think beat the index that they're measured against over 15-year periods?
Uh, well, I know it's not going to be what I expect, so
Well,
maybe
what do
go a
you
little bit
think?
lower. 70%?
How about 10? How about
10.
90% failure rate? So
Oh
it's an
my God.
exercise of futility. There is no statistical evidence, never has been, for the persistence of performance, meaning no one can consistently beat the benchmark. They get lucky. That's it. They do it for a period of time. So think about that. You have a whole industry that sells the idea to people of something called alpha, the idea that we can pick stocks that will do better for you than the index. So there's two problems with it. One is it can't be done. If it could, we'd all be with that person. That's why there's so many people
Right.
trying all the time. No one can do it consistently. But two is it's irrelevant to the success of a plan. The presence or out. Think about this. If you just own equities, and I'm not saying to only buy the S&P because you need small cap indexes, you need value versus growth, the two main styles. You need international and U.S. The last 2 years or so, international has been doing much better than U.S. But you need indexes. So I'm not saying only buy the S&P, but the point is that if somebody bought the S&P or a diversified set of indexes instead of 11.5% a year, let's say they made 9% a year. If they made anywhere near 9% a year, they double their money every 8 years. Most investors don't come close to that. Alpha
Yeah.
is not necessary to do that. All right. And by trying to get alpha outperformance, they usually fail to come close to that. And that's before computing what you don't have as a penalty in index funds, which is big tax costs, because the managers have this bias that we all as humans have called the action bias. The best way I can describe it is you ever see someone in an waiting for an elevator and it's taking a long time. What do?
When they're in an elevator and it's
No, when
taking
you're
a long
outside
time.
waiting for that elevator to come, what do they do when it's taking
Oh,
a long time?
looking at their watch, maybe looking for the stairs.
They're pressing that button, right? They keep
Oh,
pressing
yeah,
that button.
yeah, yeah, yeah.
That's the action
Like
bias.
that's going to help.
Right?
Yeah.
So we all have an action bias. When you're on a highway, we always see that dangerous driver who's going in and out of lanes, trying to get to his end point faster than everyone else, not understanding that the average lane speed is the same. He's going to get there the same way everyone else does who stays in the same lane, except he's putting himself in more jeopardy. It's the same for investing. The people who get in and out of
Yeah.
investments all the time, they're creating taxes that they don't need to create, and they're not going to get to their end result after they just bought the index and stayed with it. But that's before you factor in the taxes. Now, money managers, there's something interesting in the mutual fund business that's called window dressing. Okay. And this has always amazed me. So every quarter, it's public. You can look in every mutual fund that you would own that's public. You could look and see what they own for the quarter. And what they do, because they know everyone's looking at that, is let's say that the three biggest stocks for the quarter they didn't own. Well, before the quarter ends, they're going to buy them. So they're buying high so that it's window dressing. So when people look at it, say, oh, yeah, we own those three things, which they didn't until the very end because they were window dressing.
Oh, wow.
And then the biggest losers before the end of the quarter, they're going to sell it. I'm not saying they do this all the time, but you can look it up. This gets done in the industry. So it's the opposite of what we need to do. They're systematically, to make themselves look good from a marketing standpoint, buying high and selling low, the opposite of what you want to do. So professional managers have so many conflicts of interest. And the other thing, who's managing it? They're human beings. So they're making the same behavioral mistakes as you and I. They have the action bias. So, well, this thing's down now. Let me sell it and let me go into that. And there's been studies that show investors who sell things, not only shouldn't they have sold it, but the things they sold, there's a big study on this. They looked at, I think, the E-Trade, like 10,000 accounts, something. The things they sold invariably did much better than the things that they bought with the proceeds. So
isn't that incredible?
So the short answer is, index and only index funds. The goal of investing in equities is to capture the three variables that have led to the S&P's long-term 10% return. And those three variables are, and I don't know what they'll be for the next 30 years or so, but whatever they are, you're trying to capture them. The dividend yield, which is average, call it a few percent a year for the long term. The inflation rate, 3% a year, and GDP globally, 3 or 4. That's your 10%. Trying to do anything more than that as an equity investor is foolish. You won't be, 99% of people, including professionals, won't be able to do that. Buying index funds gives you the best chance of not only doing it, but in the most tax efficient and cost effective way. Because these managers who fail to match or beat their benchmarks before taxes over 15 years, they're charging at least, in many cases, 35 to 0.5% for that service. The index funds are, in many cases, Vanguards are close to zero. So it's a disaster. Successful investors should understand there's no, don't buy into the siren call of the opportunity to get alpha or outperformance. Do what makes sense. Buy the index funds, diversify them, U.S., international, small cap, large cap, put it away, rebalance it from time to time. When one piece, if large cap outgrows small cap over a few years by a large amount, take from the rich, take from the large cap, give to the poor. And I say do it every few years. If you do it sooner than that, you're paying taxes too soon. It doesn't make sense. These trends tend to last. The outperformance doesn't, one sector doing better than it doesn't happen for 3 months. It usually happens for a number of years. And so if you do that, it's really simple. To succeed is simple. You need to have a plan, and you need to fund the plan more of as an owner of things, stocks in this case, than a loaner, bonds, and then you need to leave it alone. And that's where we come in. Behavioral. You invest human nature, which is immutable, meaning we all react the same way to fear, to greed, to envy, to loss aversion, and everything else. Doesn't matter how rich or educated we are. So it's immutable. The people who are successful entrepreneurs think I could be a better investor. They can't, because they're human beings. And I wrote an article for Barron's in the middle of 2020 that they published highlighting the habits of the world's wealthiest investment group called Tiger 21, a lot of billionaires, 30,000 or so a year to join. And what I was able to show with their own quarterly published results of the group, more cash one quarter, they'll tell you more hedge funds, is they make the same mistakes as everyone else with less money, but with two major differences. They do it with a lot more confidence and a lot more money. So behavior is critical for everybody when it comes to this, in particular, when it comes to managing it well.
No, that's great. How about you mentioned international index funds. Is that something on the international that are tied to just countries outside of the U.S., or are there specific regions like, say, Southeast Asia or what?
Yeah, let me address that.
So with the indexes. Yeah.
Broadly speaking, we use two major international indexes for the broadest exposure. So one is developed international. It's a Vanguard fund. The symbol of the one we use is VEA, and that's developed, which means it's developed Europe plus Japan. That's what makes up that exposure. That's major developed international exposure. That's all you need, in my view. That covers it. And then emerging markets, which is primarily Asia, India, which is where the global middle class is growing. According to Brookings Institute, about 11, 12 million people a month are moving from poverty into the middle class, and it's happening primarily over there. So we have exposure half in the developed markets, developed Europe and Japan, and half in the Asia, India primary, which is called emerging markets. And the symbol for that one is VWO, both by Vanguard. Yeah.
Okay.
And both of those were
fantastic.
30% last year, which a lot of people don't realize, almost twice the S&P. And they were left for dead because they hadn't performed a lot in the last 7 or 8 years. But that's what happens. Everything shifts. So you just keep balance, keep your humility, understand you don't know. The one thing I teach people is the one defining characteristic about the future is there's no facts about it. Whether you have a PhD in finance on CNBC from Goldman Sachs or you never went to college, the guy from Goldman Sachs or the woman doesn't have one more fact about the future than you do. They just want you to think they do, and they want to sound like they do so that you can buy their products.
Yeah, no, I love it. Jonathan, this has been fantastic. I've really appreciated having you on. I just love the way that you're breaking this stuff down. How can people find out more about you, more about your company, and if they want to invest with you?
Yeah, so first of all, I'll let people know the best way to find us is our website, which is, I think, very informative. It's fusionfamilywealth.com. We also have our podcast, crazywealthypodcast.com, which is available. And when I do a Fix It Friday, which is a short version, a monologue, as opposed to an interview, which is the second kind we do. Fix It Fridays is like 8 to 10 minutes where I'm identifying a faulty reasoning process that we have and how to overcome it. So those are very helpful.
Okay.
That's crazywealthypodcast.com. They're also available on Apple and Spotify and all people's favorite venues. And our minimum investment is $5 million. So the people who do invest with us would have to have a portfolio of that size. But other than that, we are all our information's on the website.
Perfect. No, this has been awesome. I've got 2 other questions for you that I ask every guest. One would just be any advice you would give somebody who's maybe just starting out in their investment journey.
Sure. The thing I can tell people is who ask me, what's the most important thing I can do if my goal is to accumulate money over time so I can be comfortable, maybe comfortably retire and stay that way? And the biggest thing you can do, it's so simple. Start as early as you can start. It's all about compounding. It's not about finding the best returning thing next year because nobody knows that. It's about finding great average types of returns, 8, 9% a year, that the kinds of returns I can sustain for the longest period and start as early as possible. That's the biggest advice I can give people.
That's great advice. How about a book recommendation? Doesn't have to be finance related. Certainly can be something
finance related because it's my favorite book, and we're talking about psychology and money. A guy who's in his 40s, one of the best writers in this business about psychology and money. His first book called "The Psychology of Money" by Morgan Housel, and it's written in a way where it's a lot of his previous articles, so you can read it in any order you want. You can look at the chapters and see what interests you, but it's one of the best books ever written on the kinds of things I'm talking about in a very user-friendly and enjoyable way. So The Psychology of Money by Morgan Housel, I recommend that for everybody. Then even if you're not an investor, it's just a great book.
Yeah. Fantastic. Jonathan, this has been awesome. I think we'll call it a show. Thank you so much for being on the Wealth Flow.
Yeah, thanks for having me, Keith. I appreciate it. Enjoyed it.
All right. If you're still here, I assume that you found value in today's show and with the guests we interviewed. Please take a minute to subscribe and to review the show. It really helps. Also, wanted to remind you to check out Bobo Capital Ventures to get the first look at our 3 new cutting-edge, first-to-the-market investment opportunities. We have only about 15 spots for each fund for retail investors, and we would love more than anything else to have our audience be part of that group of limited partner investors. Thanks for listening to The Wealth Flow, and have a great day.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.